Joining us today. I'm really excited about this session. We're going to be speaking with my good friend Eric Brescher all about the benefits of a 1031 exchange to help you defer capital gains tax when you decide to sell your investment properties. So we'll be going through a lot of the logistics and details on that. It's a very detailed and nuanced process that you need to make sure you follow to a T to make sure you don't end up with a big tax bill at the end of the day. So really looking forward to this. For those of you who are joining us from different parts of the country, we'd love to hear in the chat where you're dialing in from. Don't be shy. We usually only get one or two people commenting, but would love to hear where you're dialing in from, and also any questions that you have during the session, please post in the chat and we'll make sure that we get to everything at the end of the Q&A. So we are this is the very last of the 7-part series that we're doing today, but it doesn't mean that your clients and friends can't participate. We do have recorded versions of all of the sessions, so we would love to have them still register. We can get them links to all the recorded sessions and they can watch it at their leisure. So we hope that they will still continue to come in with registrations, which they can do at thebridgeloanguide.com. For those of you who are joining us from the FPA, we will provide a code at the end of the session today, as well as a URL that you go to enter that code so that you can claim your CE credits. So please stay tuned for that. That is only available for the live session. So those watching the recording, unfortunately, won't be able to get those CE credits, but hopefully it'll be great information regardless that we're going to share with you today. And for those of you who are not connected with us yet, on Instagram, Guy is our handle there. It's a great way to stay connected to us. We're going to be doing, I think, a lot more of this type of thing in the future, and we would love to participate with you in that. So we hope that you will connect with us there and stay informed about future events and other industry news. So with that being said, I would like to invite my good friend Eric to join us on the screen. Hello, Eric. How are you today?
Hi, Mark. Good to see you.
Likewise. So if you don't mind, maybe give the group a quick overview of who you are and about your company.
Sure, thanks for having me. So my name is Eric Brescher, and I'm an attorney and certified exchange specialist with Wintrust Bank's Qualified Intermediary Service. So I work with real estate investors performing a function that their own attorney or accountant or realtor is not permitted to perform, in that we set up the paperwork for their exchange, and equally as important, we hold the money after they've sold their property until they're ready to acquire their replacement property. And we help guide them through the process, answer questions as we'll kind of dive into their different rules regarding the equity and the debt that need to be spent and replaced. And there's time periods involved to identify properties and acquire those properties. So we help them navigate the process. I've been handling exchanges for over 15 years. CDEC 1031, which is part of Wintrust Bank, the division with which I work. It's all that I do. So I'm not a lender. I'm not looking for people's checking accounts. All that we do are handle 1031 exchanges. It's all that I've done for over 15 years. And we're one of the oldest and largest qualified intermediaries in the country. And I think we're going to talk a little bit later on. You'll ask about the role of the QI and the fact that it's an unregulated industry. We have seen Ponzi schemes and bankruptcies. So it's very important to understand who you're working with on that part of the transaction. And of course, as a bank and publicly traded, we are subject to government oversight. So it brings a different level of security to the taxpayer.
Yeah, absolutely. We have seen and some of our clients engage with some of the unscrupulous people in your industry, which there are plenty in my business as well. But yeah, and Eric and I have worked together both professionally and personally. He's helped me with some of my own exchange work, and which got a little complicated with different partners and buyouts and all sorts of fun things. So so I can vouch for Eric and know that he's the real deal, and that's why he's part of this event. So thank you for joining us and for the introduction. For those who may not be familiar with the 1031 exchange, can you just give us the basics on what it is and what the benefit is that it provides to an investor?
Absolutely. So 1031 exchanges have been around for 100 years. And I posted in the chat, I'll post again a little bit later, remind everybody that you've got a homework assignment. If you're working in the real estate industry, own real estate, anything touching real estate, they are part of a proposal by Biden with the American Families Plan to cap them. That will be incredibly detrimental to the economy, to both jobs, labor income, and we can certainly chat about that deeper if you'd like. But 1031 exchanges go by a variety of names: like-kind exchanges, tax-deferred exchanges. So we're all using it interchangeably, sometimes referred to as Starker exchanges. It permits anybody with investment real property to defer a variety of taxes so long as they buy other replacement property. Now, the taxes generally are the federal capital gains tax, the depreciation recapture tax, state income tax, assuming they're in a state with an income tax, and the net investment income tax. So those are essentially the four taxes you would expect to have to pay if you're selling appreciated investment property that is improved, that you have been depreciating. So the idea with the 1031 is it's permitting that continuity of your investment. It is in the tax code for the same reason that it was put in back in 1921, to stimulate investment in, now of course, strictly real property assets. Up until the Tax Cuts and Jobs Act from December of 2017, which went into effect January 1st of 2018, all of the personal property exchanges were repealed. So you used to be able to do exchanges of aircraft or artwork or other personal property assets. It is strictly real property now.
Got it. And can you explain some of the logistics of how it works with the QI, qualified intermediary, and just how the flow of that whole process works on a forward exchange?
Sure. So the forward exchange is really the most prevalent of the 1031 exchanges. If I had to pick a number, I'd say, at least let's say 90%. It's essentially where somebody sells their investment property first, typically because they need the money from that sale to fund their acquisition. But of course, we have somebody like Mark who generally can bring bridge financing to the equation, or of course, just traditional financing for their replacement property. And we're going to talk about why that's needed. But again, there are other types of exchanges: reverse exchanges, improvement exchanges. And so particularly with a reverse, again, Mark is really helpful in the process as far as creating some bridge financing and creating liquidity for a taxpayer if they don't have the money yet to buy a replacement property. I'm generally involved anywhere from when a taxpayer is listing their property and assisting the realtor with educating them about the process so that they can see the whole landscape of how a 1031 works. But what essentially has to happen is they sell a piece of investment property, whether it's directly by themselves or through a realtor. And once it's in contract, that will go to their own, or it will then go to their own attorney to negotiate that contract and to handle the closing. However, as I mentioned early on, I'm performing a separate function that their attorney is not permitted to perform. So they will loop me in with their attorney. I will need to get a copy of that executed contract, title report, and any associated trust or corporate documents for the taxpayer. We would then generate a variety of 1031 exchange documents, namely an exchange agreement, there's an assignment agreement. We handle every exchange through a trust. So all these documents have to be prepared prior to the closing. And at the time of closing, and we provide instructions, of course, to the attorney or to the settlement agent who's handling the closing. At that time, the funds would get wired into the exchange account and trust that we would establish on the taxpayer's behalf, which would in turn trigger, based on the settlement date, the critical deadlines for them to both identify and finally acquire their replacement property.
Got it. So basically, the money has to flow through the qualified intermediary in order for the 1031 to be effective.
Absolutely. So the taxpayer is not permitted to take actual possession of the money. They cannot put it in their own personal account. That is deemed actual possession of the money. Nor can they take constructive receipt of the funds, which is if their own attorney were to hold the money, or their accountant or realtor or friend. So none of those parties can hold the money. And I have gotten calls, and I've gotten them recently. It'll come up every few times, number of times a year, and somebody will call me and say, I want to do a 1031. And I say, when did it close? When does it close? And if they say to me, it just closed or it closed last week, first of all, they've missed the boat because we had to put the documentation in place before that closing. They will say to me, but I didn't touch the money. That doesn't matter. That's an equal important part. But if the documents weren't set up in advance, then there's no exchange to be had. So an exchange is a very specific process, as opposed to a taxpayer selling their property and then buying their replacement property. It has to be structured as an exchange. And that's part of what we perform for the transaction as the qualified intermediary.
Right. And the tax implications of selling a property, especially if you've held it for a long period of time, could be potentially very, very significant, to the tunes of, 6 to 7 figures commonly. So I think the 1031 is a really valuable tool that people need to be familiar with. And it's one of we talked in the last session with the CPA, Joe Neary, about how it's one of the only benefits for taxpayers as it results to selling one asset and buying another. So if you have, like, for example, stocks or bonds, and you sell them, you're going to trigger capital gains tax. There's no way to avoid that for the most part. But with real estate, the tax code is so friendly to real estate investors, at least as of now, and everybody should sign that petition and check out that website that Eric posted in the chat. Because this is something that is very impactful for real estate. It encourages development of properties, which provides housing and other things. So this is something that's definitely, as an investor, something you'll want to keep an eye on. And we'll probably be posting over time once the legislation kind of gets sorted out. But I think the impact of the 1031 exchange is massive. And it could either promote more development or people buying and selling their properties, or it could just encourage people to just sit on them indefinitely. So agents need to be familiar with this if they work with investors, because this could be a reason that if this does get repealed or pared back in some way, agents need to be aware of that, because it might be an objection that their clients have to selling an investment property and buying another one. Because if they're going to trigger a $500,000 taxable event, that's a problem.
And within our industry, we have engaged Ernst & Young to do a study, as well as Lynn Pedrova, which were some economists, and we recently got these results. And just in short, I'll just kind of give you 3 takeaways. It's estimated that 1031s are generating 568,000 jobs this year, $27.5 billion of labor income, and $55 billion of value added to the economy. So those are very significant numbers. And again, it takes less than a minute to click on that link, put in your information. It'll automatically generate letters to your congressional representatives. And I really, please, that's your homework assignment, everybody, is to go do it, and to please send that link to everybody that you know. And if you have any questions, of course, about 1031s or about that, would be happy to answer those, offline if people want to discuss.
Yeah, absolutely. And we'll be putting up Eric's information toward the end of the session today, so you guys can get in touch with him, and we'll be posting about it through our Instagram account. Another reason why you should stay connected there. So Eric, what are the typical fees that an investor would pay to go through this, through the 1031 process?
So with a forward delayed exchange, which again is the bulk of the transactions, you're looking in and around $1,000. It's a very inexpensive option to defer the variety of taxes that we mentioned earlier. It's a highly commoditized process. Now, that being said, there are sometimes hidden fees that people should be aware of. In our case, we're a bank. We pay all the interest on the account of the taxpayer. I can't say the same for all companies within the industry. Some may charge a significantly higher fee and pay all the interest. Some may, charge sort of a comparable fee but not pay the interest. So it's something else sort of that should be addressed and thought about as it relates to. Now we're not in a particularly high interest rate environment right now, but when we think back years past when we were certainly a few percent, that can add up. If we're talking about money that might sit for up to 180 days till a property is acquired.
Right. And can you talk a little bit about how the logistics are different for a reverse exchange, which for those who aren't familiar with it, is basically where you buy a new property before you sell the one that you currently own? There are some unique characteristics of doing it that way that I wanted to make sure people are aware of.
Yeah, and I don't know that I fleshed out earlier when we were talking about the process. I thought it might have been a question coming up, but when a taxpayer sells their property and title passes to the buyer, there are two time periods that are critical deadlines that are triggered. They would have 45 calendar days to identify potential replacement property. And simultaneous with that, beginning when title passes to the buyer at closing, 180 calendar days to close on one or more of the identified properties. Now, in a reverse exchange, you are actually acquiring your property, the replacement property, first, and then gives you 180 calendar days to sell one of your existing investments. So if you only have one, makes it easy. We all understand what it is that you are going to sell, hopefully within that 180 calendar day period. And again, taxpayer may not have, maybe they have the finances to do that. We do these regularly. So it's something that's been blessed, and there's RevProc in order to do this. And it's sometimes referred to as a parking transaction, where we park title to this replacement property, because a taxpayer can't do a 1031 with themselves. So they can't hold title to two properties at the same time that they want to do an exchange on. So it's a little bit more of an involved process. And again, it's a great place to get Mark involved as well, because if they don't have the luxury of the money from their sale, then he, as the bridge guy, he's going to be the guy to help create some liquidity so that they can acquire that property first. And then once they sell their property, it makes things easier. We complete the transaction into the property they acquired. And I'm over.
Yeah, and
just not to get everybody into
that. Of course. Yeah, there's always nuances, and I've been through a fairly nuanced 1031 myself, as you know. So finer details are probably better to be taken offline. So we'll focus on the general parameters here. But with the reverse exchange, one of the challenges that we have is just the way that the structure or the title is held during that period where you've acquired the property but have yet to sell the one that you currently own. So can you talk about the logistics of how that works? Because it can actually be a problem for financing, and you need to make sure that your lender is okay with it. This is something that we've done extensive research on, and it can be a major problem for financing, or at least need to be structured in a way that allows for it. So maybe you can talk about the entity structure and how that works.
Yeah, sure. So typically what happens is the way that really the majority, far and away, 95% of the transactions occur, is where we're going to serve as not only the qualified intermediary, but what's called an exchange accommodation title holder, where we are going to sit on title through a special purpose entity. So the taxpayer would either give us a brand new clean LLC to use, or we can get that formed for them. We will be the sole member of that LLC. So we are sitting on legal title as the owner. The taxpayer can be the manager. So if there's anything that has to take place, whether it's construction, and that's a slightly different exchange, or if it's just collecting the rents, managing the property itself, That's something that the taxpayer does. So it's net lease back to them, and they manage, operate as if it was theirs. They collect all that income. But so we're sitting on title. And so if Mark has a client that he underwrites because he knows them, they've got a good net worth and all of a sudden they say, well, Mark, you know what? I'm doing a reverse exchange, and Eric Brescher and his company are going to sit on title for this. They're going to be looking at them like, what do you mean? What's XYZ LLC that's sitting on this title that I thought you, Joe Schmo, were going to acquire? And I did my underwriting based on you. So it's something that, you're right, does potentially trip up lenders. But to understand, there are put and call agreements at the end of that 180-day period at the most. It will be transferred, those membership interests assigned back to the taxpayer. So nothing has to change by way of the deed and title. If we set up XYZ LLC or whatever, 123 Main Street LLC, whatever it is they like, that's what's going to sit on title. And when we unpark and unwind the transaction, we are going to assign those membership interests back to the taxpayer to complete the transaction. So nothing needs to change. Now, from a lending perspective, again, that becomes lender by lender. I was just on a call earlier today on a reverse exchange, and that lender was, because of the relationship, was not with me, but with the taxpayer, was not requiring the taxpayer to sign personally. But presumably in the worst case scenario, they might have to sign personally, and it would be maybe for a date certain of no more than 180 days, and then maybe that would just drop out, so it would be purely non-recourse after that. Those become sort of business decisions that the lender would make, and I know Mark probably has a variety of relationships. So, bank by bank, it may vary slightly, but it really, if they understand them, and we're happy to help them to hopefully understand them, it really becomes less of a concern.
Right, and what you described is exactly what the challenge is with lending, is that the person who's borrowing the money, the individual who's applying for the loan, is not the person that's on title until they've sold the other property. So it's a little quirky, and you have to work with lenders that are okay with that, and ones that are also okay with the fact that the property is going to be temporarily at least held in an LLC, maybe permanently once the other property is sold. And that sort of leads into one of the other questions that I have, as far as the most common rules, so to speak, of the exchange, whether it be like what entity you can hold title in on both sides, or debt replacement, like kind exchange. So maybe you can kind of talk about some of the most common rules that people should be mindful of.
Yeah. So again, post Tax Cuts and Jobs Act, the one thing that was left open was, how do you define real property? Because again, everything else was repealed. So we did get some final regulations that came out just at the end in December of last year. And the good news is that all real property, sort of as we kind of know and expect it, has remained the same. So fortunately, they didn't say, well, no residential property. I mean, anything could have happened, right? So there were some proposed regulations, and then we got the final regulations. And in short, there are a couple little tests we use, but all real property, as you would expect it, is still treated as real property. So a condo, a shopping center, a multifamily, a piece of land, all can be, first of all are defined as real property. Even co-ops, technically stock and lease, are treated as real property. They do look to state law. New York treats it as real property. So all real property is exchangeable for all other real property. So when we talk about that like kind requirement, common misconception is, I'm selling a 2-family, I have to buy another 2-family. That is not correct. So that's just something to consider. It can all be exchanged for one another. I think there was another part of the question which I'm not fleshing out for you there.
Yeah, the debt replacement and which entity would be on either side.
Okay, so yeah, with regard to the taxpayer that does the exchange, the taxpayer that sells a piece of investment property has to be the same taxpayer to buy the replacement property. So it raises a whole host of potential issues. if Mark, for example, has a 3-family rental and he owns it in his own name, and he comes to me and he says, I want to do an exchange, great, we can handle that. Now, I would certainly encourage Mark to have some liability protection, right? So on the acquisition side, if Mark sets up a single member LLC disregarded for tax purposes, that uses his social and he is the same taxpayer. So although Mark sold individually, if it's a disregarded entity that acquires, that's okay. But if Mark and I own a property together in an LLC, as a multi-member LLC, that's going to be treated as a partnership. That's going to have its own tax ID. That's the taxpayer. So if we have Mark and Eric's LLC sell 123 Main Street, well, Mark and Eric LLC has to acquire the replacement property. So that's something that oftentimes trips people up, because maybe Mark just wants to get his cash and go with, just call it a day. Or maybe I want to go buy something in Florida, Mark wants to go buy something in California, and then we're kind of at a stalemate. So there are some strategies that can be employed, hopefully well in advance. It's referred to as a drop and swap. There are some other strategies where you maintain that LLC and do what's called a swap and then a later drop. So these are some other things to think about, that if you or you work with investors that own property in partnerships, maybe think about getting ahead of those situations, because sometimes I've worked with realtors and they might be speaking with somebody that approaches them and says, hey, I want you to find me a piece of investment property, and they get all excited, but unfortunately they don't understand that they got a partnership and they don't get to just take their share and do their own exchange. That's something that comes up really way too often, that people think that they can do that. So that's at the taxpayer level. And that also has to do on the replacement side. So if I am doing an exchange and sell a piece of property and Mark says to me, hey, Eric, I got a great investment and I love it, sounds good to me, I can't buy a membership interest in his LLC because a partnership interest is not exchangeable. Now, if he sells me a tenant in common interest in the property, that can be okay. So there are sometimes strategies. There are also sometimes issues with that. If there's a lender, maybe they're not going to be okay with a tenant in common arrangement. So a whole host of cross currents can be things that you need to think about. Do you want me to talk about the debt and equity aspect now, or was there a question?
Yeah, sure. Yeah, why don't we touch on that just briefly, just the basics.
So again, just high level view of the exchange, one of the core requirements to defer everything, and it's not an all or nothing proposition, but we position it as, if you want to defer everything, all of the net equity from the sale, so meaning sale price minus customary closing costs, which would include the realtor's commission, transfer taxes. Of course, then you're going to have to pay down the mortgage, whatever that principal balance is, whatever that net equity number is, all needs to be spent. And, very big and, that principal balance that is paid off on what we call the relinquished property, the property you're selling, has to be replaced on the replacement property. Now, again, not all or nothing. So if we sold something for $2 million and we had a $500,000 mortgage, let's forget all the miscellaneous expenses, we'd have $1.5 million of equity, right? If we wanted to buy something and defer all our taxes, again, we'd have to spend that $1.5 million of equity. We would have to replace that $500,000 mortgage. So we would expect that we're buying something for at least $2 million or more. If we want to buy something for $3 million, that's fine. We use that $1.5 million of equity, go to Mark, get a $1.5 million loan, you will defer all your taxes. But if we trade down in value, which you are permitted to do, and we sell for $1.5 million, we sell for $2 million, and now we buy something for $1.8 million, we can do that. And we'll just open ourselves up to some taxes on the $200,000 that wasn't reinvested. So not all or nothing proposition, but you'll open yourself up to some taxes to the extent you don't spend all the equity and replace all the debt. One of the common misconceptions, people say, oh, I know, I just need to spend all the equity. No, you will have a tax issue on the mortgage that wasn't replaced. Or sometimes people say, oh, I know, you just have to buy something equal or greater in value. Again, no, because in our example, if we sold for $2 million, had a $500,000 mortgage, if we buy something for $2 million, but only use $1 million of the equity because Mark gives us $1 million loan, well, we're going to have $500,000 of cash in the account at the end of the exchange, and that's going to be subject to tax.
Right. And I think one of the important takeaways from that is that the best practice, so to speak, in most cases is to make sure that you are increasing the price of the real estate. So if you own something, as you mentioned, that sells for $2 million, you don't want to be looking at $500,000 properties unless you've got multiple ones that you're going to go into. Otherwise, you're going to open yourself up to taxes. So the concept of this is that you're trading up, which is why we sort of coined this session trading up with the 1031 exchange, because that's the most effective use of the 1031, where if you follow all the rules, of course, that you're going to defer all of your gains. Now, it doesn't mean you have to. As you mentioned, you can trade down. And actually what I did personally is I used those gains, but used it to buy 2 properties. So the sale price of what I sold was, I don't know, somewhere around $1.5 million, let's just say. And I ended up buying 2 properties that totaled over $1.5 million. So we were able to defer all the gains. So you can actually spread it out between more than one property.
Yeah,
so that could be another effective way to do it.
Yeah, no, absolutely. So diversification both into different assets is absolutely permissible. So that's another, as I said earlier, sometimes people think they're selling a single family or 2 family, that they have to buy another 2 family. Again, not the case. It doesn't have to be 1 for 1. You can sell one and buy several. So that's from a diversification standpoint. And then also just geographically worth noting that all property in the United States is exchangeable for any other property in the United States. You just can't cross the border. So foreign property can also be exchanged for other foreign property, but you can't sell something in England and buy in New York. You can't do that.
Got it. And I know there are a lot of people out there that sort of try to skirt the rules of this, and that's a risky endeavor, because if you get audited, you're going to end up with a potentially hefty tax bill. But one of the things that comes up in conversations with our clients, I'm sure it comes up with you as well, is how long does this property need to be a rental property before it would qualify for a 1031 exchange? Because we get calls and say, oh, this has been my primary residence for years, but I'm going to rent it out on Airbnb for 2 weeks and then try to do a 1031 exchange. So maybe you can comment about how that works and how the IRS may look at that type of situation.
Yeah, so on that point, I mean, first of all, as it relates to a primary residence, there is the Section 121 tax exemption. So for somebody's primary that they've lived in 2 of the last 5 years, for a single person, the first $250,000 of gain. For a married couple that files jointly, the first $500,000 of gain is tax exempt. So that's typically the strategy that's available for a primary. Now, there are many applications where somebody may have a 2-family or 3-family. I just had a call earlier, somebody selling a 3-family. They have used 1/3 of it as their primary residence. So that can be bifurcated. They can utilize the Section 121 exemption for 1/3 as it relates to their primary piece, and do the 1031 exchange on 2/3 that has been purely investment. As it relates to how long these things, look, the longer the better is quite honestly the only answer. We do take some cues and look to a 2-year holding period as probably an acceptable period of time. It's worth noting, we talked earlier about some of the different types of real estate. Even a second home or vacation home, they've created a safe harbor whereby you can have some element of personal use as long as it's also rented out. I'm going to save all the nuances. Where if you can fit in that box, you're going to have a bulletproof transaction. So there are some applications, but 2 years, we take some cues from different parts of, again, the second home vacation safe harbor related party transactions have a 2-year exception. So that's something that I think is sort of safe to use, but it's always about intent. So this is definitely not for people that are flipping properties. Somebody that buys a property, little spackle paint, gives it back to a realtor 2 weeks later to sell, doesn't look like they ever had the intent to hold it as an investment. Now, there can be exceptions. Somebody, if I own a single family that I rent out and Mark's my tenant, and 6 months into it, he says, Eric, this is the greatest place I've ever lived. I'm never leaving, and I'll pay you 3x, 2x, whatever it is that I agree to. Sell me the place. Well, okay, I never intended to sell this. I intended to treat it as a rental property indefinitely, but an offer fell out of the sky that I probably can't refuse. So that's a different sort of set of facts.
Got it. And can you defer the taxes through a 1031 indefinitely, assuming everybody signs this petition and we keep things as they are now?
Well, so yeah, 1031 exchanges are not a one-time proposition. So this can be utilized over and over. The interesting thing is that the data shows that really people generally, and I don't quote me on the exact number, but it's a pretty high number, 88%, I want to say, actually end up paying taxes. On a later sale, do not do another 1031, or maybe 2 sales later, don't do another 1031 and cash out and pay tax. So that's just something to think about. It sort of defies this, swap till you drop little slogan that people have heard. It just doesn't appear to be the case.
Right, but it could theoretically be generational to a certain extent, right? If you have the same entity structure that's consistent all the way throughout, and you sell properties every 10, 20 years, whatever it may be, and then you hand that entity off to your children or grandchildren, those 1031 benefits don't necessarily go away. Is that right?
Correct. No, this is something that absolutely has been done on generational basis. I mean, with farmers and just goes on and on. I mean, absolutely.
Sounds good. All right, so I'm going to throw some hypothetical questions at you, sort of somewhat rapid fire. One of the tactics that successful investors use, and we've talked about this in different contexts throughout this series, is the BRRRR method, which is basically you buy, you renovate, you rent for top dollar, you refinance the cash money out of that property, which you can then use for other things or other properties, and then you repeat, meaning you do the same thing with another property and another property. So can you theoretically pull those cash out proceeds out, and would it create a problem if you've done a 1031 exchange, for example, and now you've replaced the debt, so you've satisfied those requirements, but then shortly afterwards, let's say 6 months later, you cash some of the equity out to buy something else? Does that create any kind of problem with the 1031 that you may have already executed?
Well, so it's a good question, and ultimately, really, I would defer to the taxpayer and their advisors as to their comfort level. There are some that put forth the concept of what's called the nanosecond rule, in that they don't care if you waited a nanosecond after closing on your replacement property to refinance. Now, I think that's aggressive. I think that waiting until at least the new tax year probably looks better. Of course, as always, there can be exceptions to things. If you bought a property, multifamily that you were renting out, and 2 weeks into it, the roof collapsed and you weren't going to wait around for insurance proceeds, and you refinance the property to create some liquidity to put back in there, I don't think anybody's going to have a problem with that. So on a case-by-case basis, but yeah, I would certainly say that if you wait, you let it, old and cold a little bit to refinance and pull out some liquidity, I don't think should be too problematic.
Okay, great. What if a client who sells their property wants to use, let's say, a portion, I don't know, whatever, we'll make it up, 25% of the proceeds that they want to use towards something that doesn't involve buying new investment real estate? What are the implications of that? Let's say you wanted to spend $100,000 to renovate their own personal home, but put the other 300,000 toward an exchange. Is that possible? Can you do that?
Well, so going back to what we talked about earlier, it's not an all or nothing proposition. So if they knew that they wanted to just take $100,000 at the time of closing, they could certainly let us know. We build that into the documents. Of course, the settlement agent would need to know, hey, give 100 grand to Sally Smith. I mean, so yes, they can take funds. They are going to lock themselves into taxes on that. There's no turning back and saying, oh, let me just put that money back in. Can't do that. So typically people will send it all unless there's an immediate need. They'll send it all to retain that option to defer it all. And again, doesn't require them to use it all. And whatever is remaining at the end, we would return to them.
Got it. And then they would basically just pay taxes on whatever portion they didn't use toward the investment real estate, correct?
Correct. And so, but to be clear, if we are holding proceeds, there are some limitations. We can only send that for the real estate or things surrounding that transaction, maybe an appraisal, the very limited, to pay a legal fee, very limited universe of expenses for which we would release money. If they say, hey, you know what, I want to go buy some furniture for my house, not going to happen. So, that's a conversation. Now, there are what we call an improvement exchange structure, where similar to the reverse, we have to sit on title while the work is being done. And so we can structure that. There are some time limitations, again, that 180 calendar days to get that value added to the property. But it's good to know. Now, probably just worth noting to the extent there are realtors on the call, but there are many buildings that are not going to permit an LLC. And so that can trip up transactions sometimes. And certainly we talked about co-ops. I mentioned those earlier. Typically are not looking for investors, but again, on a building by building basis, that might be acceptable, but just something to keep in mind. Important to find out if you can buy property in the building for investment.
Yeah, absolutely. And one of the other things I really wanted to point out, because I think it's really important, is these deadlines to identify properties on we'll take it as a forward exchange. So you have 45 days to identify properties. Would love to hear your anecdotes on how many properties you can get, whether you can swap them out. But the timing is really important, because especially right now, we're in an ultra competitive market where you're going to be competing against other bidders on pretty much every, property that anyone might have interest in, for the most part. And that 45-day window goes fast. And I've been the recipient of the stress of getting close to that deadline. And one of the things that I experienced with one of the properties identified is that it looked great on the surface, and then we got the inspection back, and then that one was a definite no. So maybe you can talk about how that 45-day window works, if there's any exceptions, what happens if you get a bad inspection, does that give you any leeway, or are you like, no matter what, you have to be done, or you have to buy that property regardless of a terrible inspection once you hit that 45-day window?
Yeah. So these are statutory deadlines. There are no, hey, the seller is messing with me, or the due diligence doesn't look good. I don't have discretion to say, hey, Mark, all right, I'll give you a little more time, right? So, it's called a deadline, and wouldn't be a deadline. I get that question though all the time, can I change it out on day 50? And the answer is no. So a couple things. To go back to, we talked about the reverse exchange. If there is a specific geographical area, maybe this is something used within somebody's trade or business, a warehouse, factory, something. If there is a specific maybe zoning requirement or otherwise, that's where a reverse exchange becomes also a little easier for people to do, because they can find that property at their convenience, and assuming and hoping they're confident that they can then sell their current investment within that 180-day clock. And the same can be said even for residential property. So if there is something specific, you don't want to go buy a property anywhere. Like, look, if you're if you've got millions of dollars and you want to buy a net lease property, it probably doesn't matter where you're buying that, right? I mean, if it's true triple net property, the tenant is just paying the taxes, the insurance, and the upkeep, and you're just collecting a check every month. So it doesn't really matter where that is. You don't have an active management responsibility. But if you're looking to buy something within an area that you might manage and have to go take the trash out and go fix the leaking faucet, then that's again another area to maybe structure it as a reverse. Or as you're saying, very hot market, tough, you're worried that you're not going to be able to buy something on the back end, so lock in and buy it on the front end and then sell afterwards. So just again, quick note on the reverses. But again, and just to clarify, just to be a little legal about things, but they are 45 calendar days. So there are no exceptions for Saturdays, Sundays, holidays. And within that period of time, most people use what's called the 3 property rule. So using our example of selling something for $2 million, they can buy or list, they can list up to 3 properties without regard to the fair market value. So if they want to list 3 properties that are $10 million each, $20 million, no problem, but they're capped at 3. If they want to list more than 3 because they don't know what they're going to buy, or they in fact plan to acquire more than 3, we can talk about the 200%. Now that allows them to list 5 properties or 10 properties. But in addition to giving us the address, they're going to have to give the fair market value of each property. And when we add that together in the aggregate, cannot exceed 200%, hence the name, or 2 times their sales price. So if we sold for $2 million, we're capped out at a total of $4 million in real estate. So unless they're looking to trade down in value to property, probably not going to work. Now, there is one other exception called the 95% rule, but I'm not going to get into that at the moment. So that's a little bit. Now, to your other question, before I forget earlier, was about changing that out. Now, within the 45 calendar days, no problem. They can be swapped out. And so and quite honestly, I don't recommend people constantly send me an identification every time they're looking to buy something. They can really wait till day 40 and say, all right, look, these are the 3 that it looks like I'm going to buy. Now, if something changes within the next 5 days, swap it out, send me, okay, rescind my prior ID. These are the 3 that I'm planning to buy. But once we're past that 45th calendar day, that's it. Those are the only properties that they're permitted to acquire. Now, like everything, and I said before, but sometimes there's exceptions, right? So if there's a presidentially declared disaster, if we have fires in California, flooding in the Midwest, hurricanes and whatever it may be that might affect a local geography, there are extensions that are granted from time to time. Again, not our control. They're typically posted on the IRS website, and it will generally get them another 120 calendar days for either their identification or to complete their acquisition. So that's something that they can look for. And there are no current COVID extensions. There was one last year that expired in the middle of July. I certainly hope and expect that there won't be a need for another one. But so I'm regularly asked that, and there are no COVID extensions at this time.
Got it. So one of the key takeaways there is don't wait until day 40 to start, making offers on properties, because you need lead time to get through that inspection, to get through the negotiation. In certain states like New York, when you get an accepted offer on a property, that doesn't mean you're going to be the one buying the property. There could still be another buyer that swoops in and gets it from you because they offer more while you're working on your contract signing. So you have to be careful. You really want to start that process like right away, or potentially even before you've sold your current property that you're going to relinquish, because you have to allow for all the time you need to do your due diligence, to get into contract or escrow, which again is a different process depending on where you're located. But that lead time is important. If you're identifying properties for the first time that you're just going to see on day 43, good luck. You're going to take a shot in the dark that this is actually going to work. So getting started early in that 45-day window, or even before it starts, is that's the key. And one of the nice benefits that I took advantage of was that, when you're doing a 1031 exchange, there's usually a significant amount of assets that you're trying to defer the gains on. So, because otherwise, if it were, $10,000, it might not even be worth the expense of doing it. But one of the powerful things that I utilized was the ability to turn one big gain into more than one property investment, and to really diversify, as you mentioned earlier. And I think that's another thing that I want to call out. There's no specific question related to that, but I wanted to point it out that is your opportunity. You come to a 1031, it's almost like a fork in the road, where you could put all that money into one property and have a ton of equity in one property. Or if you're a really savvy investor and you're doing it, potentially with the intent of expanding your side hustle, you can, maybe cut that down payment in half and buy two properties rather than one, or three or four, and really start building up more properties that will hopefully appreciate over time and give you positive rental time. So I think that's something that I also wanted to call out just from my own experience. I'm benefiting from that. When we did the exchange, a year or two ago, I now own 3 units when I only sold one. So it can be a really effective tool, and it's important to call that out, that fork in the road where you get to decide what you're going to do with this chunk of change, so to speak, and you can really make good decisions or bad decisions at that stage. But you don't want the timing to be the reason that you make a bad decision if you can avoid it. So get started early. So one of the questions, something that's become obviously very popular, is short-term rentals throughout the country, and also we call ADUs, which are common in California and other markets. ADU stands for additional dwelling unit, whereas for the most part, the most common use is like a converted garage that's a legal rental space. So how does it work if you have an ADU, or you have a property, let's say it's kind of a second home that you use periodically, but you also rent it out short-term rentals? How does that affect 1031?
Well, and there is a safe harbor for second homes / vacation homes, and I think we touched on it briefly earlier, but your personal use is quite limited. You can only use it up to 14 calendar days. It's the greater of 14 calendar days, or 10% of the amount of time that you've rented it out. And you do, in fact, have to rent it out at least 14 calendar days. And that's for the 2 12-month cycles before you sell the property, and then on the acquisition side for the 2 12-month cycles. So it's a little bit tough to fit into that box for many, but it is there and it's available. So that's something to consider. As it relates to a property where, again, as you say, there's a component ADU, you're typically gonna, as I mentioned earlier, like with a 3-family, if some of it is the primary residence, but there's an investment component to your property, then depending on that percentage amount, you should be able to do the exchange on that percent. And we'll hope and expect, and I'm not somebody that does an audit of their books and records, but that it's being treated as such by the accountant, that it's being depreciated, they're collecting rent and declaring rent. So that's something that would be expected along with that.
Yeah, and you just led in perfectly to my next question, which is, what happens if somebody doesn't declare rental income on their tax returns? Can they still do a 1031 exchange if they're, intentionally not reporting that income to the IRS?
Yeah, I mean, that's a tough spot, right? I mean, underreporting your income is a big problem. By the way, I see a question here, good question that I should probably tackle here. And the question is, if you need to spend all the money from your sale on your 1031 and you had enough of it, could you pay cash for a property and get a mortgage after? And that's a great question. And so, yes, you're not forced to take another mortgage, although Mark would prefer that you do. But as I talked about, if you sell something for $2 million, pay off a $500,000 mortgage, want to buy another property for at least $2 million, 2.5, whatever it is, you can substitute fresh equity and buy that property all cash. So you're not required to take another mortgage. You are required to replace that debt. So most people typically will take another mortgage. But yes, you can substitute fresh equity, take it down all cash. And then to Mark's question much earlier, I think I answered it that way the prior time that we spoke. But I think, again, I think that's would fall in line with a better reason as to why you refinance shortly after acquiring an investment property is if you did substitute fresh equity and now you did that for purposes of acquiring property in a very hot market where sellers were only looking for all cash buyers. I think that's a little bit more palatable as to why you're refinancing shortly after to pull. And look, if you're going to leverage it to the hill, well, then you're not really meeting that need. But if you're just pulling back your 500,000 that you added, I think that certainly looks a whole lot better and more reasonable.
Yeah, and it also leads into, and this is part of a discussion with a financial advisor, and here's a perfect example of how having all these professionals as part of your network is so important. Because Jennifer, you asked a question, but the argument that I would have in that case is, why would you want to do that, right? If you make a cash offer, you acquire the property, take the financing afterwards, that's a perfectly acceptable thing. But the return on having that equity in your home or an investment, granted, you won't have the expense of a mortgage, but it's also keeping you from using all that equity to buy more properties. So you're sort of like putting all your eggs into one basket. And I think that that's a different point, but relevant to the question here is that you could do that. But the question is that a good idea from an investor standpoint to have that much equity tied up in that property? If it's just temporary, then that's fine. But on a permanent basis, leverage can be really important. I'm not just saying that because of what I do for a living, but really because I believe in it. And I'm actually in the process of cashing equity out of 2 of my investment properties to try to buy something else, because I believe in the leverage, and using the bank's money to be able to build your side hustle, I think is a powerful part of this. So we're close to running out of time here. So I have one last question for you, Eric. Let's say that I know that timing keeps coming up, because for me personally, it was stressful, that 45-day window to identify. Are there any Hail Mary solutions where if you haven't identified, or maybe you get just horrible inspections, or you realize that these houses are about to fall down, and you don't end up buying one of those properties you've identified, is there any Hail Mary solution that you could potentially save the taxes with?
Well, many people use either as a backup or for a residual piece. So if you sold for $2 million, you found a great property for $1.8 million, you didn't want to have to pay the tax on that $200,000 shortfall. Delaware statutory trusts have become a very viable option and as a backup for people looking to get into passive investment property. And so that's something people could look into. They're sold as securities. It's a co-ownership structure. They are quite illiquid, but it's there. So if somebody has a significant tax liability, they're hell-bent on a specific piece of property, but want to protect themselves in the event that it goes south for some reason, that's something that I would say is worth considering and looking into, and probably should be looked into very early on in the process, so that you're not making a rash decision on the 45th day.
Right. No, it's good to know. I would agree. It's not something that you want to just stumble upon on day 44 and a half. You want to kind of know what those options are, but it can be a way for you if you don't identify the properties in time, or you don't get an accepted offer because it's such a competitive market, or whatever it may be. There are some solutions to where you could defer the gains. But you did mention a good point in that the DSTs are very illiquid. You don't really have much control over your investment, although there is some potential return on that. It's not an ideal scenario for an investor to tie your money up into that. My understanding is that they're not so easy to get the money out of eventually either. So there's some downsides, but at least you have an option. You're not just completely stuck paying the taxes. So I appreciate, Eric, thank you so much for joining us today and sharing your wealth of knowledge with everyone. I think this is a really important topic because we're talking about the whole life cycle of an investor. And this is a really important one to kind of sell and restart, right, with more properties or one larger property, and kind of continue to develop your real estate side hustle. And this, I think, is a really important piece of that and a really effective tool, and just another example of how the tax code is very friendly, at least at the moment, to investors. And I do want to call out again the link that Eric put in the chat to petition, so to speak, for these benefits to continue. I think it's really important for real estate investment, and that obviously trickles down into a lot of other industries and job building and other things. And not to get political or anything, I think it's definitely something that as an investor you want to pay attention to and contribute, even if it's just a minute of your time to sign that petition. So Eric, thank you again so much for sharing everything, for being a great resource. I'm going to put up a slide here with your information so that people can get in touch with you if they have any questions. But thank you so much for sharing with us today, and for being a great partner for me. And I hope people, will benefit from my own experiences. Sometimes I've found really great professionals like yourself. Sometimes it's taken me a while to get through a couple of bad ones to get to the good ones. But I'm providing a direct line to somebody who is at the top of their game, and an incredible resource. Helped me with a potentially very complex 1031 structure with buyouts of partners and LLCs and all sorts of things that were not so straightforward. So Eric is a great resource. Feel free to reach out. I'll offer on your behalf, Eric, that you'd be happy to speak to anybody that has questions about this process. And
of course, certainly feel free.
Yeah.
I know you got my number on there, but and regarding the chat, I don't know that people watching it recorded will see it, but please feel free to reach out to me. And there is a site, 1031taxreform.com, and there's a little side aspect, take action, and you just it takes less than a minute. You plug in your name and address, your zip, and it automatically generates an email to go to the congressional representatives. And so I encourage you to please do that. And again, I can always be reached directly, and my number is 917-455-1551. And I think Mark has a slide or something. So Mark, as always, thank you. And I encourage everybody to call Mark for their financing needs. Always a great resource on my end as well. So thank you so much.
Thank you, Eric. Thank you so much. So as far as some logistical details, again, this is the last of our series. Kind of scary how fast it all went by. This was really a lot of fun. I hope the attendees learned something new. I know I personally learned from every session that we did, something I didn't know before. And that's why we wanted to do this, is to bring education to all the important nuances of investing in real estate. Because if you take one misstep on any one of them, you can really, really make an impactful mistake that could haunt you for a long time and cost you a lot of money. So I've been trying to be very transparent about the mistakes that I've made, to help people not repeat those, and also to highlight the professionals that I have in my own network that I think are a great resource for others as well, that would be more than happy to help people regardless of their location and state that they're in or where they're investing. I think most of the professionals that we work with have the ability to work nationwide, and I think that's really important. So Eric's information is here. Most of you know who I am and know where to find me, but our information is here as well. And we really appreciate, Eric, you spending the time again to educate everybody on this important topic, and look forward to future collaborations with you as well. So thank you so much. For those of you who are interested in continuing the dialogue, what we would strongly recommend doing is emailing us at mmteam@freedommortgage.com. We would love to do a one-on-one consultation with you, because it's great to get all this information, but if you don't do anything with it and you just sit on it, then it sort of defeats the purpose. Even though we want to educate people, we want to also inspire them to actually take action and to build your own real estate side hustle. And it's something that I think could be impactful both for you personally and also potentially for future generations, which I think is a pretty cool thing about real estate. So please email us, excuse me, at mmteam@freedommortgage.com. We are also have just recently created a Facebook group specific to investing in real estate and creating that side hustle. So you can reach out to us. We'll connect you there, and it will be a great forum to bounce ideas off of each other and questions, and get professionals to weigh in on any details that you're looking for. So thank you again. In just a moment, I'm going to put up the slide for those of you joining from the Financial Planning Association to be able to claim your credits. Thank you to the FPA for their partnership and for helping us promote this event, and to all the members there who we've had the fortune of being able to connect with, both through this event and through other events as well. So thank you to the FPA, and thank you all for attending, and we will continue to bring education to this topic over time, and we really look forward to engaging with you. Contact us. Let's do a one-on-one consultation. That's probably where you'll get the most value of all. So we'll put all these details together that you learned and make it into an actionable plan for you. So again, thank you so much. Have a great day. Keep in touch, and we look forward to helping you along your real estate